Welcome back to Fast Market here on the Schwab Network. Let's bring in our next guest for our cash tag segment. It's going to be Landon Swan. He's a co-founder at LikeFolio. Welcome back to the show, Landon.
Thank you. Great to be here.
All right, to kick off to actual important names here for earnings season with Netflix coming up after the close today. We've had 5 days in a row after hitting all-time highs last Friday. We've been down 5 days in a row, but I mean, the expectations and the bar is really high on this one, maybe warranted at this point. They're supposed to continue to grow subscription rates. They're not losing subscribers by any stretch of the imagination. Do you have the data that backs this up, and what are your expectations moving into earnings?
Yeah, I mean, I'll tell you, I think that this move down over the last little bit is more of an opportunity than anything. I mean, this is, it's the clear leader. I mean, they have 250 million subscribers, I think 277 million, more than any other streaming service. So they're the number one player in this space. And then you just got to look at, are they holding or growing their lead, and how are they measuring that? And I think that's really key because, we do expect a slowdown in subscriber growth, not losing customers, but, that derivative. We're expecting a slowdown in growth, and you can kind of see it here. I mean, the traffic is, it's kind of moving off a little bit, but when you look at how they're talking about, they're kind of, I wouldn't say they warned about this, but they put this out there to investors that I think that we're not expecting a lot of continuing growth on the growth, but we are looking at changing the way they report. Instead of talking about purely about the number of people who are subscribing, it's how much money's being brought in, because they've got a little bit different model now, right? I mean, they cracked down on the password sharing, and they're also bringing in the ad tier, which both of those have worked really well. So the ad tier, I think it's $7 a month, and it's supported by obviously ads. And that's grown significantly year over year, I think 34%, whereas the paid subscribers is only growing 16%. And I say only, but that's a really good number also. Last quarter, they had plus 17% revenue, plus 48% EPS. And you can see here in this chart, it's, just look at from left to right is the time, and then you can see Netflix is in green, and some of the competitors have their own color, YouTube in white, Roku gray, and Disney in pink. And so what you see over time is Netflix is growing this ad revenue over time, which is really important. That's plus 17% on a year-over-year basis. Whereas if you look at Disney, they're falling off. If you look at Roku, they're falling off. Even YouTube was growing, and it actually took a hit this last quarter that they reported. So Netflix is going the right way when it comes to pulling in more ad revenue. And I think that that's probably why, one of the reasons that they're more focused on the dollars coming in rather than the number of subscribers, because it's going to be easier to pull in cheaper subscribers, but you'll have less revenue per subscriber. But if they're ad supported, you can get a lot more money on a per subscriber basis. So I think that's really the key, is what's the shift that's happening within Netflix. They have a lot of quality programming. They have a lot of the top programs out there, but just getting the twofold revenue strategy going, where it's not just people paying on a monthly basis, but it's also that ad tier that's obviously doing well. I think that's why this stock has, basically doubled in the last year. And, again, a little bit of a pullback over the last little bit from maybe 736 to 695, something like that. So I see it as a bit of an opportunity heading into this earnings. I think a lot of the lower growth rates for subscribers is somewhat priced in, but all the other data that we have is pretty strong for Netflix. So again, I think this is an opportunity for long-term investors.
Landon, here's the stat that blew my mind. September of 2022, they had $533 million free cash flow. June of 24, $6.8 billion. So this company, for the last 2 years, has just banked cash. And their moat and the volatility that was involved in streaming in general, they are the clear winner and so far ahead now of everyone that they are uncatchable, I think, in my opinion. That doesn't mean the stock's going to go straight up. As you know, it can be pretty volatile. It sold off pretty hard here. Is this sell-off, is this weakening ahead? Because they're going to put up good numbers with, what they're doing with advertising now is just another level of growth for this company. But $700 seems like one of those tough levels for this stock to get over. Can this earnings, is this enough to do it? Keep it above that 700 level?
Yeah, I think so. And I think that, as an investor, you got to zoom out and think, where's this company likely to be in a year? They've clearly shown the ability to diversify their strategy, crack down on the password sharing, which consumers really didn't balk at because you want it. So you're like, all right, fine, I'll pay for it, right? And do this ad supported tier, which is hitting that demographic that's a little bit shy on paying $20 a month, and so they'll pay $7 and watch some ads. So they've been able to execute that. They are by far the dominant player in the space. And you look at who they're beating. I mean, they're beating Amazon, they're beating Disney, they're beating Hulu, Paramount, HBO Max. I mean, they're beating everybody. They're the number one, and they're almost to the point where they're the default choice for streaming, right? I mean, it's really becoming that strong. So yeah, you got a little bit of a dip here. Am I certain that they're going to go up on earnings? No, but I think it's greater than 50%. I think it's worth a bet for sure. Our earnings score, by the way, is plus 38. So it's, strong, not ridiculously strong, but, strong to the bullish side. And when you think about, the average consumer, the average consumer in the U.S. has 4 streaming services and they're paying $61 a month. Netflix fits in very well into that. So they're just one piece of the puzzle, but they're the default piece. That's the first one that everybody has. It's the last one that everybody cancels. And so long term, I think this is just a little bit of a buying opportunity. Short term, I'll bet on the upside. I think it's greater than a 50% chance that they're going up. I'd probably put it at 55 or 60%. And for me, that's I'm sure you guys can structure a trade that takes advantage of those odds all day long. So I like it here. And again, a lot of it has to do with just how dominant they are and the fact that we don't see that changing over the next 1 or 2 years.
Yeah, in April, during a call, they said they're going to stop reporting subscriber growth numbers in 2025. They want everybody to focus on revenue because that high margin ad revenue business, that average revenue per user is going to be what people should be focused on. But, Landon, I keep on hearing rumblings that they're going to raise prices maybe potentially on this earnings call. Does that help or hurt them? And does that help or hurt the stock? Because not a lot of people are going to give up their Netflix subscriptions. We know that.
It's becoming a consumer staple.
Yes, it is. Just like an Apple, like an iPhone, yeah. Right. So is that going to help or hurt the stock? And what's your earnings score on this one?
I mean, if you look at what's happened every time they've raised prices, you figure out why they're probably going to do it again. I mean, people just say, all right, I use this every day. My family's on it all the time, tons of hours, and it's worth $2 more a month, right? Eventually, maybe it gets really expensive if you keep going $2 and you keep adding that up. But right now, I think people are going to take it, and it's just going to add more of that cash that Kevin was talking about. So I think investors would like it. I would like it as an investor if they raised prices slightly, because I don't think they're going to get a lot of attrition. And I think it's just going to produce more cash, frankly. The earnings score is plus 38 out of, that can go from negative 100 to positive 100. So plus 38 means we're bullish. And usually the threshold is if we get above 20, we're willing to make a bet on it. So plus 38, we're definitely willing to take a bullish trade on this one.
Yeah, and I think key going into this report is they might report good numbers. Watch the guidance because they always lowball the guidance for some reason. Maybe keep that bar low so they can beat it on next quarter. But, yeah, we'll have to wait and see. Great stuff, great data. As always, Landon, appreciate it.
Thank you, guys.
All right, that's Landon Swan, co-founder at LikeFolio, breaking down the data.